Thank you for joining us for our fourth quarter 2019 review. I'm again joined by Adam, who will cover asset class returns, both in the short and longer term, and then touch on some key economic events that affect our investments. And then be followed by Andy, who will cover our size and style, strategy and positionings, and go into more detail on an unusual occurrence, which is growth's outperformance, pretty significant outperformance for a 10-year period. The history, as many of you will know, over long periods of time, growth stocks tend to underperform pretty significantly their value opposites. But in the short run, that's not always the case. In the short run, it's very normal to have a couple-year period where growth outperforms. To have 10 years of it is something that we've not seen going back almost 100 years previously. So there's clearly something different going on. And we've been sort of searching, trying to get an explanation for this, and Andy will cover it in more detail. But the underlying earnings, so in other words, the fundamentals of growth versus value companies, seem to be the primary drivers. What we're looking at here on this slide is analysts' expected earnings growth rates for growth versus value companies. So you can see growth companies tend to have higher growth expectations. Makes sense. Value companies have less expected growth. The trend downward over this 20-year almost period of time is something that's somewhat significant. I think that's part of the explanation for growth's excess return. As growth has become scarcer with the overall decline in earnings growth rates, it makes the advantage of growth, extra earnings growth, more attractive. So that's part of what's going on. But the real significant aspect is the next slide, where we see, and this is kind of shows you the inherent inaccuracies that go into actual earnings growth versus forecasted earnings growth. So we're looking at earnings growth that was actually posted essentially for the same period of time. In 2001, it's a 5-year ahead forecast. So in 2006, we're able to look back and see the actual amount of earnings. And sometimes it's higher, sometimes it's lower than what the forecast would be. We see kind of a bottoming that occurred about 10 years ago, and then a resurgence in growth or earnings growth for growth companies, and a sort of a persistent underperformance on the value side of things. For value to have averaged something around 5 percentage points versus their forecasted growth of closer to 10 percentage points is a significant amount of underperformance for a very long period of time. And I think at the end of the day, this is actually what's driving that. And Andy will go into that in more detail. I hope I didn't steal too much of his thunder. So at this point, I'll turn this over to Adam.
Great, thanks, Lowell. And again, before Andy gets back into the weeds around the growth versus value trade-off, I wanted to take a minute to just take a 40,000-foot snapshot of the markets, both in the last quarter and really trailing 5 and 10 years, to give everyone a good context around where we are across different asset classes. So this summary here looks at the third quarter of this year and the relative performance across what we consider to be the 6 broad asset classes. So on the left-hand side, we've got the equity bucket. On the right-hand side, the fixed income bucket. And what you'll notice is, especially on the equity front, where we've got primarily the domestic markets, international developed markets, and emerging markets, we've had a fairly flat third quarter. It might not have felt that way if you were focused on the daily swings in the market. We had some relative significant up and down days in the short run, but the net effect of that was something that looked fairly flat. The emerging markets being the key laggard here. China considered one of the, still considered one of the biggest emerging markets by sheer size, with a really big drag on that sub-asset class, which was down about 4.25% through the 3 months, as we're looking back. what you will notice is the income-oriented asset classes, particularly global real estate and the fixed income markets, held up fairly well. A big driver behind this is just the continued dip in interest rates, specifically here in the U.S. So as interest rates on safer investments and cash fall, it makes these relative asset classes all the more attractive and helps boost up their prices. So the bond market, as you'll see in a second, has been fairly resilient through through a lot of the chatter and the noise through the year. Down below, just for context, it gives some good historical perspective going back almost 20 years, looking at the average quarterly return, best quarter, worst quarter for each of these different categories. But all in all, I think across the board, a relative flat quarter compared to what we've seen in the last 12 to 18 months. If we take a longer term view, go back looking 1 year, 5 and 10 years, you'll notice just some of the trends that have been transpiring. And as Lowell and Andy talk about the performance gap between domestic growth stocks and domestic value stocks, there's behind the scenes, in a broader perspective, been this other similar trend play out on a global scale, which is really the performance gap between domestic and international equities. Just as growth versus value has persisted in a historical, on a historical run, the same things happen with, going back 10 years, the U.S. market averaging low single digits, whereas international developed and emerging markets, really falling behind. A lot of this has to do with the environment that we're coming out of and the monetary policy. Stimulus measures that have been put in place has been, I think, driven a wedge in this performance gap and caused it to persist. But, those clients, and in our case, many of our clients, they have some type of asset allocation that they're trending towards or tracking towards. And one of the things that you probably notice is a pain point is just the fact that the U.S. market has continued to persistently outperform the rest of the world. And again, at a historic clip. Seeing this play out over 10 years of this magnitude is quite significant. So that's the asset class side of things. For those of you interested, at the sector level, so far this year, what we've really noticed is the safer and the more income-oriented sectors like utilities, REITs, consumer staples have held up and been some of the more attractive growth sectors. Energy and materials, some of the more commodity-sensitive sectors have been hit quite a bit. A lot of this tied into the trade conversation and what's going on with China. So as we jump into the economy and just the backdrop from that end, I've got up here a good summary going back the last 12 months, and the chart and the solid blue line is representative of the performance of the global stock market and its ups and downs throughout the year. Layered on top of this is some of what I consider to be the key headlines throughout most of 2019 and trailing back into some of 2018. So overall, U.S. economic data has remained relatively stable. It's continued its slow to moderate growth clip. We've got an employment environment that could still be defined as healthy. We've got unemployment at around just under 4%. We've got wage growth that's continued to be prevalent and present, and coming in August a little bit stronger than expected. In terms of payroll additions and new entrants to the job market, we have seen that kind of level off and flatten a bit. And we've also seen consumer confidence flatline and slightly decrease. And a lot of this can be, I think, attributed to the uncertainty related to the trade conflict that we have with China. So while that's happening and playing out, we've got central banks still trying to contribute what they can to the markets in terms of stimulus. We ended up cutting interest rates this year. We did a cut in July, a cut in September. And just to give you a really good context around the uncertainty in short-term market and economics when, coming into 2019, most people probably would have anticipated a continued rise in interest rates. And because of some of the outside external factors that have been, at play and contributing new levels of uncertainty to the market, we've been cutting rates. And so that's caused a little bit of a tension and conflict. It could, cause consumers to, think twice about their, their employment prospects and their spending prospects. And it also has trickled down at the corporate level with spending decisions. So we're going to look long term, but we certainly can't ignore the fact that some of the the trade discussions has started to trickle down into what we're seeing in the economy. So the spending number is a really big one. Consumption represents about almost about 3/4 of our GDP, which is our total economic output. So how corporations and individuals are deciding to make spending decisions as they think about the election, as they think about what's going on with China, will be interesting to watch unfold and transpire. And the last piece of this is inflation. So, we talked about in prior discussions the fact that, even though we're discussing an economy that's, mid to late cycle in terms of its growth track, we also have a relatively tame and low inflation environment. And so what we've seen is a little bit of an uptick from an inflation perspective with core inflation, which measures a lot of the goods and services that we use frequently as a proxy, has ticked up to just under 2.5%. So we're coming out of a pretty long stretch of well below 2% inflation, and we're clipping up here at around 2.5% in terms of an inflation burn rate, which will, again, just like the next 12 months with the election cycle, with what's happening with China and the Fed's decision making, will be interesting to watch all of that unfold together. So what does this mean? Again, in spite of some of these uncertainties, the markets continue to be fairly resilient. We field questions quite a bit from clients, and one of the most frequent questions that we've been running into is the market at the top? Have we hit the end of the road in terms of our growth outlook for U.S. equities? And we took it upon ourselves to collect a little bit of data as it pertains to what does short and intermediate term market performance look like after you've hit that proverbial top of the market. So this is almost 100 years of history, and what this is showing is the annualized returns of the market after it's reached a new high. So we've got a 1-year period, a 3-year period, and also a 5-year period saying, once the market has reached a new peak, what was the average return over the next year, over the next 3 years, and the next 5 years? So when we say average, there's both ends of that spectrum. There are periods where it was much higher than this and periods where it was much lower. But I think the concept that this really solidifies and endorses is, the market does not necessarily ever reach new lows. It's always reaching new highs. So when you hit one peak, it doesn't really say anything or provide any sound data about, whether or not, the market's overvalued or has hit the end of its run. In most cases, the market is going up. You look at the percentage of years and months and quarters where the market's up versus down, the data would tell you that it trends up more than it trends down. So this is of no surprise to us. But for those clients that have been concerned just about the timing and what you hear in terms of the news when they talk about valuations and where we are in the market cycle, hopefully this provides a little bit of reinforcement of the fact that, not only is a longer term perspective important, but that the fact that we're at new tops really doesn't support any case or argument against what's going to happen in the short term. So that's the market and the economy and where we are. And with that, I'll leave it to Andy to dive into our strategy, the changes that we've made or not made, and what we see going forward.
Yeah, great. Thanks, Adam. It's always nice to see that high-level view of how asset classes are performing globally. But now we have an opportunity to drill down a little bit further, specifically into how U.S. stocks have done so far this quarter and year. So what we're looking at here is performance by size and style over the third quarter. In this presentation, there will be a few charts, and whenever you see the gold, that indicates that we're talking about value. Whenever you see blue on the charts, that means that we're talking about growth. And what you'll notice is that the third quarter was a pretty strong pro-value quarter. In fact, when we look at the smaller cap companies, growth stocks actually lost some ground over the quarter, even while stocks in general rose. And a big reason for that is the month of September. So we saw a particularly strong and sudden divergence between value and growth companies. And as what typically happens with sort of any factor timing, the reversal happened quickly and with little to no warning. There's also no real reason for it. Nothing's really changed in the backdrop. It's just one of these things that does happen through the market. It was picked up by some of the major financial media organizations out there, as the move makes some uneasy, as broad indexes like the S&P 500 tend to be biased at this point towards the mega cap tech companies that have fueled much of the growth in those indexes. So while some might be concerned, we view this as welcome, given that we implemented a value tilt earlier this year. And in fact, because we implemented this tilt earlier in the year, we were positioned to take advantage of this move. So while this was just 1 month, it is a trend to watch moving forwards. And with that, looking year to date, we see that value and growth are actually performing very similarly. On the larger cap side of things, growth maybe has a slight edge, but value is winning the day in the small cap space. So I will say, regardless of where you're invested, double-digit returns across the board is a strong response to the market correction that occurred in 2018. And in fact, much or all of the losses that occurred there have been made up. And as we saw with Adam earlier, the market is making new highs again. So this has been very strong performance here in the U.S. stock market year to date. For those of you who've been with us on these webinars in the past, you've seen this chart, and you know that I like to call it the wave chart. So really what it's meant to do is illustrate the cycling dynamic we aim to exploit with our size and style U.S. equity strategy. Real quick, as the line moves up, that indicates that we're in a pro-value phase. As the line moves down, the pro-growth phase, and it kind of goes back and forth like a wave would, hence wave chart. So given the pro-value quarter we just experienced, there's no surprise to see pro-value momentum continue. And in fact, just in this most recent period, we actually crossed the origin that indicates about the halfway point in a pro-value phase. Given that a typical style phase lasts 18 to 30 months, our expectation is that there should be another 12 plus months for value to really begin to break out. One thing to note is this is a well-established and well-organized trend towards value. We also do the same type of chart with regards to size. Real quick, as the line moves up, we're pro-small cap. As it moves down, we're pro-large cap. But again, those of you who have been here with us in the past will know that we've seen kind of a moderation of this cycling dynamic happen here in the 2000s. And we've talked about while the value premium is still strongly supported in the academic literature, there is some question as to whether the small cap premium ever existed in the first place. You know, it may have been more of an anomaly that once discovered was priced out of the market. But either way, we've seen kind of a slowdown in the cycling dynamic with regards to size. And in response to that, we've been market neutral for some time, and we remain that way. However, one quick thing to note is in this most recent period, we have seen some momentum pick up for large cap companies. We'll have to be in wait and see mode to see if this is the start of a meaningful cycle in that direction or just continued noise, but it is something we are watching. So the question Lowell posed at the beginning of this presentation is, why has growth outperformed for so long? The value premium states that over the long term, we would expect to see value stocks outperform. And to put some numbers on what Lowell mentioned earlier, is the average long-term outperformance in any given year for value is in the 2 to 3% range. And while it's not completely unprecedented that we see growth outperform, it does happen. If we look back historically, we can go back to about the 1920s where we have good data. Growth outperforming in any given 10-year period happens only 16% of the time. And the thing that's notable about this most recent 10-year period is it's not that value has done poorly. You've still more than doubled your money over the past 10 years investing in value stocks. It's just that growth companies have done much better, almost 100 percentage points, in fact, of excess return over value. But given how rare it is for growth to have such an extended run, there could be a couple reasons for the outperformance. It could be the case that growth companies are seeing prices run up, completely ignoring fundamentals like earnings growth and profitability. We'll call this maybe the dot-com reason for outperformance. But it's also possible that growth companies have actually been able to realize higher than, above average earnings growth expectations. It's one of the reasons why there is a value premium in the first place. Is it's very hard for growth companies that have sky high growth expectations priced in to actually live up to those expectations. But if they do, then better performance is justifiable. So going back in the post crisis expansion era, what we have seen is we've seen earnings growth in the amongst growth companies actually begin to take off quite a bit. And during the same time frame, we've seen value companies trend sideways or maybe even a little bit down when it comes to earnings growth rates. Especially in this most recent few years, we've seen growth companies really begin to pick up earnings. So what this indicates to us is that the performance of growth companies has been justified by sound fundamentals. I know that there's always a persistent worry about market valuations, and Adam touched on that a bit earlier, but this data does splash some cold water on those concerns, as we have seen strong earnings growth in the growth space. So given this data that I'm presenting here, why are we tilting towards value right now? And I will say that this data does give us some pause in terms of our confidence of our pro-value bet. Because if you look at growth companies all by themselves, they don't necessarily look overvalued. However, it is the case that value companies look especially cheap right now. So this chart is a chart measuring the relative valuation of growth to value. Our measure here for valuation specifically is intrinsic value, but we could have used more common valuation measures like PE or price to book. They do show the same type of pattern here, but we prefer intrinsic value because included in this calculation are forward-looking expectations. Over the long run, growth does tend to earn a premium over value. It's about 1.5 times per this measure. But what we're seeing right now is that growth is significantly more expensive than value right now. And given that growth performance has largely been fueled for sound reasons, value actually looks especially attractive. Now, we do have a value tilt on, and we have talked about increasing that value tilt. But it's not necessarily, and I will say, if this were like the dot-com era reason for growth outperforming value over this time frame, then we certainly would be tilting even more aggressively towards value than we are now. And like I said, we want to keep some meaningful allocation towards growth companies, but value just looks especially attractive right now. Earnings matter, but prices matter quite a bit as well. So this is why we're keeping our current value tilt on. All right. So with that, we want to thank you all for attending our webinar. We always do get a few questions in the immediate aftermath of these, so please feel free to reach out to your advisor if you have anything that you want to go over. As a quick note, we are recording this webinar, and we will be sending it out once we have it downloaded. So if you want to forward it to any friends or family, please feel free.